Okay, I can see the questions box. I can see the chat. Hi, David. Hi, Paul. Right. I hope everyone's good today. My name is Peter Davies. I've been in the trading game since around 2005. Not coincidentally, that was the year my financial advisors lost 30% of my net worth. And what I did at that point, I decided to take over from them. And to be honest, at that point, I just figured that even if I lost money, I'd still save on the fees they were charging me. Now, at the time, I was already regularly attending networking events in Singapore, and there was lots of people from the banking and the proprietary trading world in those events, people I really didn't talk to before I had this problem with the financial advisors, and people that spent their time at desks like this one here all day, doing things you can do at home. Also, people doing things that we could never do at home. So I met one guy who retired at 35, and he'd been running a department for Royal Bank of Scotland out there, writing massive barrier options for Forex. And from someone like that, there's not really a lot you can learn except that you got into the wrong career. So basically, as I was going to these events, instead of kind of running away the moment I heard something, the topic of finance mentioned, I started engaging with these traders to find out what they really did. Now, at the time, I didn't actually realize how lucky I was compared to most traders trying to pick up trading skills. Even luckier though, as I kept those contacts in the professional world, many of those are now my customers, like the professional firm in the picture here. That's me sitting at the desk of one of the traders in one of the professional firms as a customer of mine. So today, with your permission, I'm going to share something with you that will help you become a better trader, something professional traders taught me. And we're actually going to do something quite simple. We're going to look at 7 trading setups, 7 really good trading setups. And for each setup, we're going to look at when they work, so which market conditions, why they work, why would buyers and sellers engage after we get in and move markets our way, what confirms that a trade is setting up, how to confirm the trade is going your way, and what you should see if the trade is failing. Now, this is very simple and very effective for those that want to just take this away and start looking for those setups. Now, I chose these specific setups to look at because although each one is different, they're composed of certain building blocks very common in trading. Building blocks like these, which are simple, common, yet effective. I think the best word for them is events that professional traders consider in their trading. And for those new to us here at Jigsaw, you might be thinking, well, how on earth am I going to see those? I don't even know what some of those are. And the answer to that is, you're not actually going to look at anything different. You're going to look at mostly the same things, but you're going to view them differently. Anyway, the point here is we're going to zip through 7 setups quite quickly with a focus on those common building blocks. So as I go through each one, I want you to try and recognize the common parts that we discussed in the others. At the end of the session, you should be able to go back to your own setups and see them in a new light, actually break them down into components, make them work better for you. Maybe throw 1 or 2 away, maybe replace them with some of the setups you see today. So what we're going to do, just jump straight into the first setups. Now, the first thing you're going to notice, it looks like an egg with a stick in it. It's not a chart. So the first thing I want you to do today is forget about the market as something that moves from left to right and start thinking of the market as it is, which is something that moves up and down. A market where at any point, some people are long and some people are short, where some people are happy, some are in fear, and we know some are in tears, where time frames aren't actually that important, whether it's a 1 minute, a 3 minute, or a 60 minute, really doesn't make a lot of difference. There are just traders positioned, and there's traders looking to enter the market, and there's traders looking to exit the market. There's really nothing more than that. So on this diagram, the line shows us where we traded so far, and the oval represents an area of higher volume. In other words, this oval is a trading range, an area we've been trading for a while where there's no evidence of the range breaking yet. So we've all seen trading ranges before. So what kind of trading range is it? Well, this could be an all-day range, or it could be one of those smaller, 15, 20, 30-minute micro ranges that form as the market takes a breather in an overall trend. So all that matters for now is the market has been in a range for a while, and that volume is built here, and that volume is observable. right? If you can't see an observable difference in the volume in that area, it's not this setup. Now, this isn't a range trade, it's a pullback trade. So the next thing we need to see is this. At some point, the range breaks to the upside, and it basically looks like we're no longer in the range anymore. Then the market pulls back to the top of the old range, and then it continues up from there. And that's the setup. Very, very simple setup, right? You go long from the high of the old range, but it's the range as defined by volume. So there'll be a couple of prices, one or two prices, where the volume switches from being high here to being low here. And that is the inflection point. But obviously, there's more to trading this than just, okay, I see the level, I'm going to buy it, right? So let's consider the things that we want to know about every trade we ever take. First thing we want to know is, when does it work? Okay, so first, this works in a trending market where we tend to take a breather, build some volume before breaking in the direction of the trend. That's one time it works. Also, in slow directionalist markets, the same setup applies, but being within a trend makes it more reliable, right? Why does it work? Well, very simply, as you build a range, long and short positions build up here. When we break to the upside, the shorts from this area get stopped out. When the market comes back, those people that were short the market are less likely to engage to the short side in the same location just a few minutes later. It's like a fear of recurring loss, right? If you just lost money going short at 29.50 and the market comes back to 29.50 again, you do not short it again, right? You just think it's a bad idea. Now, also in a trending market, if we break in the direction of the trend, it's much easier for traders to engage in the direction of the trend again. So if you see a market pushing up and it pulls back and then it starts to move back up, lots of people jump on that. It's just the path of least resistance. So what confirmations are there? Now, these are the things that are unique for your trades. So in this case, the first thing we want to see is a stop run. So when we break out first from this high volume area, we need to see a lot of volume when it breaks to the upside. There should be people stopping out. That means some sort of pop or explosive move as we leave the range, right? So if you just lazily go out of the top of the range here and it just kind of lazily ticks up, then there's nobody being stopped out. The premise for the trade is basically not there. So this trade, yes, it is about the market pulling back to here, but it's really very much also about how fast it moves away from this area here. Okay, so we want to see a stop run, want to see the market come back. What do we expect to see if this trade isn't working? Well, quite simply, if we start to carry on down, move back down into this range, kind of lazily moving back down into the range, that means there's no follow through. We're not getting our expected move. The trade's over. If this trade is working, what you're going to see is quite early traders jumping into the market here, going long, nice, decent pace of the market. It's not going to be as fast as this initial breakout here, but you should see the market will start to tick up. And then as it ticks up, traders realize that the path of least resistance is to the upside, and my pointer's not visible. I was using my mouse. Let me just, right. Okay. As the market moves to the upside, we should see the pace of the market start to tick up, right? So it's a nice gradual pace. Now, what's the risk reward? Because risk reward is really important in trading. So your risk is some number of ticks back into the range. Can you see my pointer now? Give me a Y, somebody, if you can see my pointer. Y. There you go, Carl. Thank you. Right. So if the market starts ticking down into this range, you might give it a couple of ticks, grace. But as it starts to grind down into the range, you're done. The reward here is basically through this high here and basically unlimited reward to the upside, right? So the sky's the limit because you're breaking out, you're continuing the trend, you're carrying on up. So this is a trade with a really, really good risk reward ratio, good upside potential. It's pretty clear where your risk is. And a trade where you don't have to be right all the time, right? If you get these right 50% of the time, you'll make good money on them. Now, the only downside with this trade in reality is timing it can be a little bit tough sometimes. It's quite easy to miss these trades when you first start. So the turn here can be quite fast, and it will often turn without warning you, apart from the fact that you knew in advance roughly where it was going to get in. So sometimes you just have to kind of bite it and put a limit order in here and just wait for it to come back. Now, does this thought process make sense in terms of what to ask yourself during the trade? You know, why is it going to work? What am I looking for? What are my confirmations? What are my confirmations if it's not going to work? To actually be trading by considering other people's reactions, by thinking about the probability of something occurring, and then managing the trade by whether those things are occurring or not. Okay, because it makes a lot more sense than by if this line crosses over that line. Okay, on to another pullback trade. Now, you might say, wait a second, he's just done a pullback, and aren't all pullbacks essentially the same? Well, of course, all pullbacks have things in common, but there's also very specific entry triggers and management tells that play out differently with different types. And so we're going to go over a few different types, and it's going to become clear why shortly. So here's stage one, a market that's moving upwards, no volume built anywhere, and then we see this happen. We see a move down, and it ends with a large amount of volume traded at one or more prices. That's going to be one price on thicker markets like bonds, S&P, currency futures. It's going to be a couple of prices on crude, NASDAQ, Dow Jones, DAX, right? This volume here is often going to be one-sided. So you'll often see a lot of selling being absorbed by bidders. So it might be two-sided. We see a lot of contracts trading on each side, but quite often it's one-sided. So we have something called an iceberg, and if you don't understand the terminology, it's fine. But basically, if you have an iceberg here, it means that the bidders that they're selling to are trying to hide their side. So typically, you might see something like there's 500 bids at the price, and then 2,000 contracts selling to those bids, and at the end of those 2,000 contracts, there's still 500 there, right? So the bids never went above 500, but 2,000 lots sold there. If you see that, if you don't understand the terminology, don't worry about it. If you see that at the end of a pullback, it's a really good tell. It means somebody is absorbing the selling, but they don't want anybody to see it. So when does this work? Obviously, it works in trending markets. It does not work in a really heavy news-driven day or very heavy one-way market. So if it's a move up after a Trump tweet, a terrorist attack, something like that, you're not going to be able to nail a pullback as well. What you're going to see is lots and lots of areas up and down where a lot of volume trades, and it's fairly insignificant. So it's kind of the normal regular trends. We'll talk about trading news events later. So why does this work? Well, what happens is as we pull back, the counter trend sellers get stuck in this area here. They and everybody else knows that this is overall an uptrending market. So as the sellers see the market no longer moving down off their selling, a lot of them stop and bail out, right? They just say, okay, I've had enough of this, which means the sellers are going to stop buying. And that means the market starts to tick up. Now, the other factor with this trade is time, right? This iceberg here takes time to build. Lots of people can see that happening. Lots of people can see the sellers get stopped. And so they also look to buy as well on the off chance that, you know, the sellers are going to get stopped out. And they also buy because, you know what, it's a great risk reward trade, because if it comes down here just below this area, you can get out. So as we lift away, traders realize, you know what, I saw a bunch of sellers get stopped there. We started to move up. Path of least resistance is now to the upside. Okay, this is not a reversal, it's just a pullback. So what confirmations are there? Well, obviously the first confirmation is that we want to see that iceberg order, we want to see that volume trade here, but also we don't want to see massive volume and a really fast move on the way down here, right? We want to kind of see a more steady, slow move before the traders get trapped here. Now, what do you expect to see if this isn't working? Well, if it moves below the area where these guys got trapped, well, they're probably not trapped, right? And it looks like maybe the bidders who were trying to trap them, they got run over. So basically, any move below the iceberg is means your trade's in peril, but that also makes it one of the best trades you can take from a risk-reward perspective, right? The other sign of failure is it can't get through the high, right? So if it can't get through the high, there's a really good chance that we're going to start building a trading range, right? So sometimes you'll see this trade fail because it can't get through the high. You'll still make money, okay? And that's fine, and that's quite common with a lot of trades, right? What do we expect to see if it is working? Well, as it pops up away from this area here, you're going to get a little pop because the sellers that sold here are going to get stopped out. You'll see a little pop. It won't be as big a pop as the first trade we look at, but you're going to see a little pop. And then you're going to start to see traders generally, start to join in, especially as we move towards the high here. You're probably going to get a little pause at the old high here, but then it will start to move through. So you're going to get decent pace, but it's not the same pace you see when there's a stop run. You're going to get that nice clean acceleration, right? So you have to know the difference between, a nice healthy pace market and something that's just popping out because lots of traders are getting stopped out. Right. Same scenario, pullback, but it's actually a different scenario. This is something called a fade. Fades are really, really important. So a fade occurs when we run out of interest, right? And it's the opposite of an iceberg order. So in the previous example with the iceberg order, that was where we had lots of positions at one or two prices, right? That's a big tell. It takes time. With a fade, it's a little bit more difficult to see, but that is what makes it such a good trade. So think about it. In the previous trade we looked at, there was an iceberg order. The market moved down. Sellers kind of spun the wheels trying to selling at a particular price. They got stuck. Lots and lots of time for lots and lots of people to see that and react to it, right? Building that volume took time. So during that time, lots of people can see it. And more importantly, there are also big players in the markets that like to nudge markets around, right? They don't nudge it 100 points on the S&P, but usually 5 or 6 ticks, it would be a typical nudge of the market. So there's some basic manipulation plays that go on. And with that iceberg trade that we saw earlier, you've likely got thousands of contracts just positioned at a couple of prices. And there's a bigger payoff in nudging people out of position when you have a lot of contracts at a few prices. So there's more interest there. The fade here is the absolute opposite of that. It's basically when there's hardly any contracts trade at prices because sellers are simply not interested. And at that point, there's literally no point in manipulators coming and nudging the market around, right? They don't want your 4 lots, right? So this is something that occurs faster. It's less obvious, but there's less chance of manipulation, which is fantastic. So what happens is market moves down and it just slows down. We often hit a price where just a handful of contracts trades, and then we'll tick back up, go back down to that price again, and see again, really nothing wants to trade there. As there's no interest in the downside, you eventually see the first few traders kind of tentatively coming in and trading to the upside, and it's not long before the path of least resistance is established again. Okay, when does this work? Regular trending conditions. So when I say regular trending conditions, if for a day trader on a market like the S&P, you can put in 3, 4, 5 decent intraday trends in a day. So I'm talking about those kind of regular trending conditions, up 10 points, down 10 points, up 15 points, finish where you started, right? That's the S&P. So I'm not talking about news-driven erratic conditions here. It's like a stately, steady trending market. Why does it work? Well, if there's no one to sell, market's not going to carry on down, obviously. Now, sure, this could revert to a range if nobody wants to sell and nobody wants to buy, but you'll likely see buyers tentatively coming into the market, lifting it up, and it takes time, right? Not everybody jumps in at once. It's not like the iceberg where we saw iceberg, traders trapped. Everybody can see it. People are jumping in. People are a bit more fearful, right? You got the brave and the silly getting in at the bottom, and then the more, the kind of less brave and more reserved traders getting in later on. Okay, so it takes time. Not everyone jumps in at once. There's no obvious iceberg here. Now, how do we confirm this trade? Well, this trade is confirmed by what you don't see. Okay, so on the way down, you don't see big sellers. You don't see really healthy downside momentum. You don't see large volume, and then you just see less and less and less interesting. Now, what do we expect to see if it isn't working? Well, if you see a flood of sellers coming into the market, you need to get out, right? So if you're relying on no sellers, and then you see a flood of sellers, even if the market doesn't move that much, but if you kind of think the sellers are done, if you see just even moderate selling coming in and ticking the price down a bit, just get out. It's not the trade, right? It's not the trade you're trying to trade, right? If you're saying I'm going to get in because of lack of sellers, and you see some sellers come in, you don't say, well, maybe this one will work anyway, right? Because that's kind of the sucker move, right? You see a flood of sellers, you get in, get out. Now, this is an interesting one. What do we expect to see if this trade is working? Well, what happens if this trade is working? The pace of trade really gradually starts to increase. So there's no pop initially, and you're actually likely to see the first signs of acceleration when you get to here. So you might not see anything that really makes you think, wow, this is going now, right? For my trades, what I like to do when I trade, I like to get into a trade and I like to see like a pop, right? I like to see a pop. And until it's popped and it's just like ticking up and down and not really going anywhere, I hate that first part of the trade. So I do like the trades where you've got the icebergs, the trades where you're trading against stops, because you get that pop. Okay, this trade isn't like that, and quite often you only kind of get that acceleration as you come up to the old high. That's often as how late it is that people realize that this is actually going to go, right? Because everyone was falling asleep on the way down. So there's no stop run, there's no huge volume of sellers getting stopped out, so you're not going to see that kind of thing. And that's where I come back to these building blocks, right? Is the building block of a pop really applicable to this trade? The building block of a pop of a stop run is a really essential part of trading. It's something you have to be able to see, but if you expect it to happen on every trade, you're going to really get confused. So that's a building block you can take back and say, you know, if you've got 10 setups, you can look at every setup and say, should this setup have a pop? Now, if you're trading something like 2 moving averages crossing over, you're actually trading something that there is no position. You're not trading against people positions. That crossover could happen in the middle of a range, it could happen in the middle of a trend, it could happen anywhere. And that kind of setup, you're not going to see a pop. So again, if you're using building blocks, you're going to see the pop when one of your setup building blocks was people positioned in a particular area, right? Like an extreme, like the all-time high, there'll be stops the other side, right? That kind of area, right? So you have to change your mental picture of the markets to one where there's actually people in positions in different areas, and you're actually trying to rely on that fact, right? It's not one of, I've got a candlestick, I've got a squiggly line, when this squiggly line goes there, people are going to do this, because you can't really justify that decision unless you know where that people are positioned around that area, right? So effectively what we see, normal flow of trade resumes. Now, most people, when they see this, they think this is the poorer trade, right? Because it's a bit more vague and it's a bit harder to spot. But I like this trade better than the iceberg. I'll take either of them, right? I just feel better in this trade, you know, from an entry point of view, because it's not as erratic and it doesn't tend to you know, when it goes against you with the iceberg, you can get it, you know, paring down against you, because there is a lot of volume that we're moving away from. So it's better from the iceberg in that respect, purely because of the lack of size traded, right? There's not so many sharks around, and also it's an effective trade that not everybody can see, and that's often better than a trade that's obvious. We all want to trade obvious stuff. I have a lot of traders that say to me, can I just fade every iceberg? And the answer is no. You can't have a one rule trading system. A trading system has to have like multiple facets to it, and multiple confirmations. Okay, on to different trade. And you're probably going to say, at this point, you're probably thinking, is this 7 pullbacks? And I promise you, this is the last pullback, right? Now, actually, this trade is one you could actually blend with one of the other trades, right? You could actually blend it with, for instance, the iceberg trade, okay? But sometimes on certain markets, your only cue to enter are other markets. So here, what we don't have one market, we've got 3. We've got the Dow, the NASDAQ, and the S&P. Now, that's because that's what I like to trade, but you could be looking at interest rates. You could be looking at energies. You could be looking at different correlated markets, right? It doesn't matter. Right, the first thing to note about correlated markets is that the correlations break down, right? So in fact, if you look at the Dow, the NASDAQ, and the S&P, we actually use the breakdown in that correlation to determine if the markets are trending or reverting to chop, right? So the presumption here is that all three markets are moving together, right? That's the first part of our setup. So in this case, we've got all three markets pulling back. They're all pulling back to different degrees, and they will all pull back to different degrees, whatever markets you follow, and that depends on the liquidity of those markets. Let me explain. Yeah, I'll explain that in just a second, sorry. So what we'll see is one of the markets is going to pop to the upside. Right, now if you look at the Dow, the NASDAQ, and the S&P, it is often the Dow or the NASDAQ that will move first. And I will say that is an optical illusion, right? It's an optical illusion, and you're going to benefit from this optical illusion, right? So the S&P futures are thicker and slower, and it takes longer for buying to become evident in terms of a price move, right? So if buyers come into all three of these markets at the same time, the Dow and the NASDAQ will show price progression before S&P, right? Another way to look at this, right? A 1 tick move on the S&P is equivalent to a 4 or 5 tick move on the NASDAQ, right? If you move 2 ticks on the S&P, the NASDAQ will move 8 or 2 to 10 ticks. It's the same traders getting in to the same markets to do different markets for the same reason, right? It really isn't one moving first, but if you've got two markets side by side, one of them moves up 2 ticks and one of them moves up 10 ticks, which one do you notice first, right? And the answer is you're going to notice the one that moves 10 ticks. It looks like it's pushing up faster, but the only thing that's happened is that traders came into the S&P and the NASDAQ at the same time. They both moved up, just one was more visible than the other, right? So when does this work? Well, this is a trending market play. So the path of least resistance is to the upside in this trade. So 1 or 2 markets pop with the trend and nothing's heading out. That's when it works, right? Why does it work? Well, arbitrage trading keeps the markets in line. So arbitrage trading is the glue that sticks the markets together. And this is where HFTs are your friend. So one market moving brings traders into the other market. And it's sort of a multiplied path of least resistance. People join moves, doesn't matter which market they join, it just brings people into all three. Now, what confirmations are there? Simply just 1 or 2 of the markets start to move up. What do you expect to see if it isn't working? Well, the markets that ticked up will fail and start to move down again. And that is the beauty of this trade, right? Because if it starts to fail, you can often get out on the S&P. If the NASDAQ starts to fail, you can often get out of the S&P before the S&P's even started to move down, right? Now, it does help, of course, if you're trading the less volatile of those markets, but you don't really need your market to move against you at all to see the moves over. If it is working, you generally see all the markets start to move up. You should see the pace of the market increase. Again, you're not going to see a stop run. You don't expect a big pop, but you do expect all 3 markets to put in a nice run up. So the key to this trade is practice and pattern recognition. There is no way you're going to get this right on day one. You do need experience working with failed trades. So the more you watch this, the more confidence you're going to get in sorting out the winners from the losers, right? And you're going to be sitting in front of your screen anyway, so why not start watching it tomorrow? Okay, enough pullbacks. Let's look at the range fade. Now, if you're trading index futures, the first sign of the markets reverting to range is that the correlations break down. So usually the Dow and the NASDAQ start to move in different directions. So what we look for first is we look for volume to build at 1 or 2 prices and for the market to start crossing over that volume from above and below. Now, again, if you're not used to watching this, I would just advise you to do so. Look for exceptional volume at 1 or 2 prices and for the market to just cross over and above, over and down from above. And you'll soon be very good at spotting ranges form before anybody knows the range. So with a range fade, you really don't want to be fading the range on the 10th hit of the extreme. The earlier, the better, right? Next thing we need to understand about ranges, they are not exact. So sometimes we'll poke through the range, sometimes we'll fall short. Now the range size is really important. If it's a 3-tick range, it's hard to play, right? There's no reward in it. If it's an 8-tick or a 10-tick or a 20-tick range, then your potential risk is worth the reward, or your potential reward is worth the risk. So key to a range fade. Spot the range really early, ignore smaller ranges. And there's 2 types of range you can play. First of all, in the short term, in a trend, you get short-term ranges form. So the markets do tend to push and then range and then push and then range. And the second type is a longer-term range in a slow directionless market. So with the first type, where there's a trend, overall trend, you're going to expect a break to the upside. So it's worth considering only playing the one side of the range, so from the bottom up. So you're not wrong if the market eventually breaks out. For the longer term range, you can actually play both sides, but most traders I know find reversing a position difficult. I'm not sure why it is, but lots of traders want to take a range trade here and they want to exit at the opposite side and be done. They don't take a trade here and go short here, reversing the trade. I'm not sure why. It would seem logical if you think the end of the trend, the range is here, that you go short, but not many people do it. So what is the range fade? Well, you buy what you consider to be the high or low of the range this time round. And quite often you'll see one of the signs you already we discussed, like an iceberg order close to the extreme, or buyers fading away at the top, right? Could simply be just we run out of traders. Could be you see one of the correlated markets start to move. So it could be an extension through the high, it could be a shortfall on the low, right? The moment you see a sign that the move's done, that's when you fade. So when does this work? Well, it works when there's a pause in a trend or a short-term range. It works when there's a general lack of news, lack of interest, or prices like FOMC, where people are waiting and seeing. Works well with ranges. And basically ranges, they work till they don't. So why this works is basically there's no commitment either way in the market. And the moment we go outside of the zone, we get into an area where people are just not comfortable. The people aren't comfortable outside of that, and it comes back down. So what confirmations are there? Well, you know, icebergs, excessive volume at the extreme, traders fading away at the extreme, correlated markets reversing at the extreme. What do we see if it isn't working? Well, we get aggressive trading into and through the extreme. And also, there's going to be an area where you've got the highest volume within that range. We call it the point of control. If you can't get back through the highest volume price in that range, that is also a good sign that the range is going to fail. If it is working, it's going to grind, right? So if I buy here after a move down, it's just going to grind to the top. No acceleration, no really good confirmation other than the price goes our way. We also expect it to slow down in the middle because that's where the most of the volume is. And when you've got to go to an area where you've traded most of the volume, that's generally where it slows down again. So as you can see so far, there's components we can share between trades and there's things that are different. So we can't expect the same pop from every setup because every setup doesn't necessarily trade into stops. Now we're just going to go over quickly another range trade, and this is a head fake. So you start off with exactly the same range bound conditions. The difference here though is on this setup, it's not something we'd advise on one of those shorter term ranges that builds in a trend. So what happens here is we start with a range and then we move up through the range. Usually it's a violent move and it appears that the range is now broken. So what happens, you get this big push up, but it is manipulation, right? And you can see why this is so normal in quiet periods, right? You get a quiet time, some big shark comes in and pushes the market up, all the breakout traders get involved, 6 or 8 ticks up, it stops and everybody's stuck, right? Why does this work? Well, we covered this, it's slow market. When does this work? Slow markets, lunchtime, summertime, any slowdown. Why it works? There's manipulation. So there's a drive up from the range, which is initiated to bring in buyers. Some of them will be stops, so people who shorted the range, some of them breakouts, right? The buying is absorbed by the same guy who drove the market up, and he's now holding a lot of short contracts, and the breakout traders are stuck in a bad position. Now, what confirmations are there? Well, this one is interesting because this is a whole cycle progression of steps. First, you get the range built, then you get the breakout with a rapid move, then you get to see the absorption above. Now, if it isn't working, obviously the first sign it's failing is if we get above this point here, right? Second sign is it can't get back into the range here. What do you expect to see if it is working? Well, first of all, the buying up here stops, as you know, a certain amount of buyers will get stuck up here and then they'll stop and then the market will start to fall down and then normally it will revert back to range bound behavior, which means we'll start moving down the range. Now, the key thing about a head fake is a head fake will give you potentially the other side of the range. So it's actually a really good one for a risk reward ratio. You want to wait till it's hit the extremes of the range 5, 6, 7 times. It's a late range trade. You don't take it on the first, second, third hit of an extreme, right? So this is for older ranges. Previous trade is for younger ranges. Now onto the last trade. This one is almost the anti-setup, because what I want to do now is consider an entirely different scenario, a runaway market. Now, if you speak to professional traders, most will tell you that their results are not linear or even across days, right? So it might be up 1,000, down 1,000, up 3,000, down 4,000, up 20,000, right? And that's just the way the results are not linear, right? So there's a lot of average bread and butter days, and then there's days where the profits are really exceptional, which is where the anti-setup comes in for a lot of traders. So this is a real payday trade. And my advice to you again is to look for this on sim before you start jumping in, right? So don't get excited about the fact that there are amazing, exceptional opportunities there, because you don't want to suffer from exceptional losses, right? So anytime you get excited about a trade, it's usually a bad thing. So the anti-setup isn't one where we're trying to pick a spot or finesse an entry. It's simply the ability to understand and recognize that external factors send the markets into overdrive sometimes, right? We might not see it for a month, then we could see nothing but that for weeks. We saw a lot of it in October, November, December 2018 with Brexit, with Trump, with the oil stuff. And we've had some great days this year too. Just one last week, one of the prop traders I know made $300,000 in a day on the 19th of July because we had a lot of volatility. And it's these people here that give us these days, right? China trade war, Brexit, the stuff that's going on in the Gulf. They're big drivers of volatility and really big days. So you've got a choice on these days. You join or you don't join. What you can't do is use those regular building blocks to construct your trades, right? So trying to fit your existing strategies to a market that's become highly volatile. So sometimes the move comes out the blue. So you'll see a market start to rise or fall rapidly without any apparent cause, which is why you have to have a news feed on hand to look at the moments things start to become very volatile. So you can see here, this was a very volatile day for oil, and we had moves in Asian shares, we had moves in oil, and you can just see, guess what was moving oil that day? So what's the trade? Well, the first thing to do is recognize it's none of the trades we've discussed so far, and it's not trading against the market. There's a lot of volatility, and so joining these moves requires you use either a larger stop or successive attempts to enter with a smaller stop. So you might get in with a one lot and get stopped out. You might get in with a one lot and get stopped out. You might get in with a one lot and get stopped out. And again with a one lot and get stopped out. But no, sorry. Last one with a one lot, you don't get stopped out. Then you go 2, 3, 4, 5, 6 lots. And that's when you get the payday, right? So what tends to be the norm with the trades I know is they scale into a larger position on days like this as the move progresses. So you de-risk by starting small, add contracts as it goes your way. Perfect thing to do with the micros. So when does this work? Well, big news causes panic or excitement, right? So that's why when it works, it causes volatility. So big news days, Trump tweets, Brexit, all of that thing, right? All those things. Why it works? Well, markets are not efficient. So when a move like this starts, we don't just jump to some new value. We see panic buying or selling that takes us somewhere new over time. Confirmations, simply the news. But the bottom line is you've got that extra potential reward. You have to manage it. You have to manage the extra risk, right? But that's not always in line with what we do as traders. Sometimes we see that extra reward and we jump in with both feet when we really shouldn't. So that's our 7 setups. Now we know what makes a good setup. It's components. It's some things that you can interchange between your traders. Setups are actually comprised of building blocks that can be reused on other setups. And this is one of the difference between traders at home and professionals. Traders at home, they want to be given a setup. Professionals are given the components of setups and told how to assemble them, like we did today. And this means they have the confidence to then assemble their own setups. And that might seem impossible if you've just spent the past 15 years as a consistent losing trader, but it's just a natural progression to creating your own setups once you shift your focus to the things in the market that actually cause traders to react. So no matter how long you've been doing things without really considering trading from this particular perspective, there's actually no reason you can't be helped. You just need a slight shift in perspective and to consider that what you see on your screens, you need to think about it from a slightly different angle, right? Now, when I first started talking to professional traders at the start of my trading career, one of the things they're all absolutely clear about is there was no magic bullet, right? So if you wonder what it is that makes trades in the professional world so good, it's this. They trade, they review, they learn. They first learn the basics of trading, they execute that, and they review. And really, if you want to know what it is we do at Jigsaw, is we basically support this life cycle. We give you tools at every part of that life cycle: trading platform, education, and the most advanced analytics system on the market. And we give you all that stuff so that you can actually progress as a trader. So you can trade, you can find out what you're doing right, you can find out what you're doing wrong. And today, if you want to see the results from your efforts, we've got a really good package for you. So we've got the Jigsaw tools, which is the best order trading platform on the market. So you can start trading using the same signals the professional use without lagging indicators. If you don't have one of these feeds or platforms, don't worry, you can get a live demo account to start immediately. We've got 10 hours of the best order flow education available anywhere, including practical hands-on drills so you can develop the skills that will keep you in tune with exactly what the markets are doing. And you get access to our cloud-based trade analytics system that gives you the power to analyze your results graphically and intuitively. And you get access to our live trader chat room, so you're actually immersed in a community of like-minded traders on a daily basis that are using the same tools and techniques. Now, I know what you're thinking. You're probably thinking, ouch, he's going to give me a really big price here. Now, a few $1,000, $1,000 a year, something like that. But you'd actually be wrong. In fact, for the next 10 people that sign up, we won't even charge you the regular price of $579. So it's $100 off for the next 10 people, and after that, the regular price kicks in. And that's for lifetime access, right? This isn't $479 a year. That's lifetime access of the tools, the chat, the analytics. And with that, I've got time to go over a few questions. Okay. Right, iceberg. Somebody's asking about iceberg. Marcos, it's a bit much to kind of go over icebergs here, but basically what it means is every trade in the market is a buy and a sell, right? So when somebody sells, there's somebody buying on the other side. So what happens is we can see the market orders, the sellers, the sell market orders. There's a bidder they're selling to, and sometimes those bidders hide and absorb all the selling, and that's effectively what an iceberg order is. If you go to the Jigsaw blog, you'll be able to see and just search for iceberg. You'll actually see some examples. And if you want to just email me, I'm on Skype, Jigsaw Trading, all one word, or Peter Davies at jigsawtrading.com. I'm just going to put that in the question. Okay, I'll just send you my email address. And just go over the questions. That's a better deal than I got in at. You're giving it away. It'll work with NinjaTrader 8 and Kinetic Feed. Kinetic's a really good feed. CQG is a good feed. The only feed that's not very good with Ninja for order flow is Interactive Brokers. With that, I'm going to pass you back to the main presenter. Sorry I rushed through it a bit at the end there, but trying to get through a lot of contact. But just remember, when you're trading setups, right, if you can actually break your setups down, you can have a lot more flexibility for actually adjusting things and beginning to recognize, you know, for this setup, what should I see after I get in? And is my trade really working out? And if you're expecting to pop because a lot of traders got in just below where you got in and you're long and it doesn't pop, then your trade is not working out. And really that's all trading is about, is expecting a reaction. You either get it or you don't. And usually if you're trading reaction-based levels, the reaction is what helps you from a risk-reward perspective. So guys, I want to thank you all for listening, and with that I will hand back.